Hey, welcome back, everyone, to the Real Money Pros podcast. I'm your host, Nick Daniels, and today we're going to talk about required minimum distributions. And when is the best time to take them? Well, not now with the markets down from the beginning of January. No, I'm just kidding, really. We're going to talk about that, but before we do, listen, I got to encourage you. Go to our website, therealmoneypros.com. There's a wealth of information there for you. You can hear the podcasts that drop every Monday, Wednesday, and Friday. You can use the Ask the Experts feature to send questions to myself and our entire team of experts. Anything you want to know about health insurance, it's open enrollment season, so maybe you got some questions. Anything you want to know about mortgages, refinancing, investments, different titling of accounts, how to set up the right kind of estate planning. Do you need a will or a trust? All of those questions and more, we'll answer them for you free of charge. All you got to do is click that little button. It's all there for you, therealmoneypros.com. Okay, so we are actually talking about required minimum distributions. It's November, it's the end of the year, and it's a question that we get asked many, many times, both from our own clients and from people who are just coming to us as a resource saying, hey, what do? I just turned 72. Don't I have to take some money out? How does this all work? And maybe you inherited an IRA that was already kicking out required minimum distributions. What do you need to know and what do you need to do? Let's talk about that today. Okay, so first of all, what is your required minimum distribution? Well, if you have a pre-tax IRA, also known as a traditional IRA, or say you have a rollover IRA because you took money from a 401k or a SEP IRA or a simple IRA. Am I confusing you yet? You take all of that money, you put it into a pre-tax IRA account. You've basically been in a handshake agreement with the federal government saying all of these years, I'm going to get a tax break for putting money into this account. So let's just say that your income was $100,000, but you put $20,000 into a 401k pre-tax. The IRS said, hey, this calendar year, we're only gonna take your taxable income as 80 grand. And that's nice. You got a lower tax bill that year. But eventually the IRS says, we want our taxes from those dollars. And when that happens, that's called your required minimum distribution. It occurs when you turn 72. Now, technically speaking, you have until April 1st of the year after you turn 72 to take that required minimum distribution. But if you did that, you'd have to take two out in that year. One for the year you turned 72, and then one for that year in which you're now 73. So maybe that's a good idea for you. Maybe it's not. You might want to talk to an advisor about your specific details. Okay, but that's kind of the nuts and bolts. That's the required minimum distribution. They happen when you turn 72. Okay, so let's ask this question here. When should I take my required minimum distribution? Well, let's talk about that for a second. I think you need to ask yourself some questions. What are my cash flow needs? What are my sources of income? Maybe you're still working part-time and you don't really need the income. Or maybe you have a rental portfolio and you get enough passive income from the rents that you don't really need the money out of your IRA account. Well, if you're not really needing the money, a general rule of thumb is, hey, it's great to let that money stay invested as long as possible because fingers crossed, the markets are going to be higher on December 31st than they were on January 1st. And if you can leave all of that money in that account invested all year long and then take your RMDs out at the end of the year, you're taking money out of an account that has gains. That's the theory, and it can work for a lot of people. But maybe you need some supplemental income on a quarterly basis or a monthly basis. If that's the case, you might want to talk with your advisor about having a monthly distribution come out, and that would satisfy your required minimum distribution, potentially. Again, generally speaking, if you're not needing it, let it stay invested for the majority of the calendar year, and hopefully you're selling out of positions to generate the cash at a gain and not at a loss. That's when you should take your required minimum distribution. But let's talk about how you should take your required minimum distribution, how you should take it efficiently, maybe I would say. So first of all, in order to know how, let's answer the question, how much? So let's take a look at my screen. I'm going to show you how easy it is to find out what your required minimum distribution would be. So let's just say that you can't find your RMD amount with your custodian. You can go to Google, type in RMD. Oh, look at that. Calculator. And there's all these one. AARP has them. Schwab has them. I like this investor.gov. This one's a pretty simple one. Here we go. Required minimum distribution calculator. What was the account balance? Oh, let's just say you've got this great problem of you have $500,000 in your IRA as of, notice this right here, December 31st of last year. And how old were you? Let's just say you're 75 years old. Click calculate. There's your withdrawal factor. What is the amount? You got to take $20,000 out of that IRA, and the federal government is going to tax that amount. Now, if you're doing this through your custodian, you should have the ability to elect to have federal taxes withheld and state taxes withheld if you would like. So now that you've seen what that amount is, and depending upon where you custody your IRA, they might have it automatically calculated for you. I know our accounts, it's automatically calculated for our clients, and they can see how much they've taken already this year, if they've taken any at all. Super easy to see. Most custodians make it super easy for their clients to see what the RMD amount is going to be on their accounts. Okay, but what about how to take it? And is there a way that you can take it from a tax efficient standpoint? First of all, understand the rules. If you do not take your RMD, and let's just use round easy numbers, you're 72, your required minimum distribution this year is $10,000, but you don't need it. You've got income coming in. Maybe you have a spouse who's a few years younger than you. They're still working. Their income's providing your monthly needs. Maybe you have some rental properties in your portfolio. It's providing passive income. Maybe you're still working as a consultant. It's not too physically hard. You love what you're doing. But the point is, you don't need that money coming from your required minimum distribution. If you don't take it, the IRS is going to tax that particular amount, in this scenario, $10,000, at 50%. Man, nobody likes paying taxes, but especially not at a 50% tax rate. So you don't want to have to pay $5,000 to the IRS simply because you didn't need the $10,000 out of your account. So don't make that mistake and pay more in taxes on that RMD than you should. The second thing I would say is if you want to be really tax efficient with your required minimum distribution, you should think about doing what's called a qualified charitable distribution. If you're charity minded at all, maybe you've got a church that you support or some other nonprofit, whatever, as long as it's a qualifying nonprofit institution, a 501c3 or something like that, right? You can make what's called a qualified charitable distribution. And you send your RMD amount, let's keep using that $10,000 example, you send that straight to the charity of your choice. And now you've satisfied the requirements to have that distribution taken out. It's not going to count as income to you when you file taxes because it was donated to charity. So it's a really tax efficient means of taking that RMD out of your account and maybe funding some charitable-minded goals that you have. Again, a great conversation for you to have with your advisor. Let's draw this up, because maybe then it'll make a lot more sense, okay? All right, so let's whiteboard the idea of a qualified charitable distribution. You've got a pre-tax IRA. It's got about $250,000 in it at the end of the year on December 31st, and you're 75 years old. That means you're gonna have to take about a $10,000 required minimum distribution. What that means for you, let's say you've got one spouse's Social Security, the other spouse's Social Security, and you've got a pension income. So your income's about $10,000. Well, this RMD gets added over here, add in that $10,000, and now the IRS says your income for that calendar year was $80,000. But what do you do if you don't need this $10,000? You don't want to spend that $10,000, but you're charitably minded? If you've got a charity over here that qualifies, a qualifying 501c3, here's what you can do. You're 75. You got this pre-tax IRA of $250,000. You got to take $10,000 out as an RMD. You bring it down over to here and you funnel it through a qualified, I hope I can spell right, charitable distribution. And what this does is it sends this $10,000 straight to your charity. They receive $10,000. It never hits your checking account. It's not counted as income, so we satisfy the required minimum distribution. Check. Have we increased your income for that year? No. So what are you now paying taxes on? You just brought your income back down to $70,000 for the year, and you start your standard deductions or other itemized deductions, and there you go. That's a pretty tax efficient way to take your required minimum distribution if you're charitably minded and you actually don't want to spend that money on yourself. Pretty cool. Now, the other question that we get asked all the time is, can I invest my required minimum distribution? And the answer is absolutely you can invest that. But now we have to talk about what the title of the account would be that you're investing that money in. Remember, a required minimum distribution is coming out of a pre-tax individual retirement account. It's coming out of a retirement account title, and that's important, a pre-tax retirement account. That RMD amount can come out, and there's a few ways that you could take that out if you're wanting to invest it. So first of all, you could sell that position to generate $10,000 of cash. We're keeping with our theme here of a $10,000 example. You sell positions in your IRA to generate $10,000 of cash. And then you could just, in our world, it's called journaling, where you just transfer that $10,000 out of your IRA over to an individual trading account. Some people call them a brokerage account. You could journal it over to a joint trading account or a joint account, all the same names. And then within that account, sure, you take that $10,000 and you invest it. Another way to do it is often you can just transfer shares in kind. If your required minimum distribution amount equals $10,000, you could just find positions within your IRA that equal that $10,000. Talk to your custodian or your financial advisor and say, let's just transfer these positions in kind, and that amount would satisfy your RMD. It keeps it fully invested that whole time. It just moves over to your individual or your joint account. The other thing that you could do, if you still have earned income, that's the key. You could take that required minimum distribution, take it out of your pre-tax IRA, and put it into a Roth IRA. But again, either you or your spouse is going to have earned income, and you're going to have to satisfy some income limits, earned income limits, but you could potentially take your RMD and get it invested into a Roth IRA. The one thing you would not want to do, it would not make sense at all, is to take your RMD out of a pre-tax IRA and then invest it into another pre-tax IRA. That's dumb. Don't even think about it. You don't want to do that. Okay, so you can invest your required minimum distributions. Now, here's the thing. When you're going through this, it can sound really, really complicated, but it's not. Again, wherever you custody your IRA, they probably have it already calculated for you of how much you need to take out by the end of the year. They're going to have calculators, as we saw. It's pretty easy to find an RMD calculator and determine how much you need to take out. It's always going to be based on the account value ending on December 31st of the prior year, plus your age and your lifespan factor as determined by the IRS. The longer they think you're going to live, the more you're going to have to take out those RMDs. And what you'll see is sort of a bell curve. You start at 72, your RMDs are going to kind of go up, again, based on account value and those age factors, but it tends to go up, peak somewhere in your early to mid 80s, and then start dropping back down. Why? Because the IRS is ready to get their hands on your tax dollars. They've been spending it like crazy all these years. It's why we have how many $1 trillion in deficit? And they're thinking, maybe here's a way we could put a drop in the bucket by getting the taxes out of your required minimum distributions. That's what I've got for you guys today. Thank you so much for listening and watching. I'll catch you again next time.